This has been, I mean, we've been wringing our hands, terribly concerned that the sky is falling. For months now, ever since Jamie Dimon's cockroach comment. How do you see the issue?
Well, look, I mean, why did anyone think there was a moat around private credit that makes it any different than other non-investment grade debt products like the broadly syndicated market or the high yield bond market? Things have ups and downs. And, we're in a phase now where private credit, which was the darling of the media and the investment community for half a dozen years, is hitting some bumps in the road. It's not a surprise. I'm old enough to remember when Drexel went under, and everyone said this is the end of the high yield bond market. And of course, people filled that gap and it went on to higher heights of AUM and returns and survived pretty well during the 2008 crisis.
I mean, maybe it's not an era of like private credit falling apart, but it feels like maybe we're just ripe for some disappointment that returns won't be as robust. And isn't that to some degree kind of the worst time to be pushing it to retail investors if we are heading later in the cycle and this is when you're like thrusting this product upon people?
It sort of depends, doesn't it? I mean, when things are unpopular is when it's probably the best time to actually go in. So it's unclear. Now look, whether or not it's a good idea for retail investors, and again, we don't talk about what retail investors we're talking about.
True.
The people who are in these funds now are not the 401k for the plumber and the electrician. These are generally speaking very high net worth individuals that are in these funds. It's not the way we think about a retail product.
There have been stories, and I was talking with Elisa Mall from the Dell family office, for example, who said some RIA came to her retired parents and was like, private credit would be great for you. And her reaction was, Mom, Dad, no, you need liquidity. This doesn't make sense to you.
I would agree that wouldn't make sense for them.
But doesn't that open some regulatory risk also?
If I'm 32 years old, I'm not going to need that money for 30 years.
Right.
Shouldn't I get the benefit of the return? This is the argument. Shouldn't I get, I'm not an investment advisor, shouldn't I get the benefit of the returns on alternatives that are available to others?
Of course. Look, if I'm a teacher or a cop, right, I get those benefits because TIAA, CREF, or CalPERS invest in it as well.
Right.
And they're, by the way, lining up to get involved right now because they see a good vintage coming after retail got burned in the last couple of bad vintages.
Right. As Howard Marks made a good point the other day, that anything that's new tends to get overinvested, over-promoted, okay? And then there's the disappointment phase. And then there's a normalization phase. It's nothing new about private credit. I mean, you had GECC Capital, you had Ares, you had Golub, you had all these people around forever making these loans. The difference was there was a pullback by the regulated banks, in part because of leveraged lending guidance and other factors, and a void was filled. Just at the time when you had low interest rates driving middle market private equity. And it's a great product for those guys. No need to go out and do a syndication, no need to get a rating. It's a lot easier. You don't have the reporting and liability of a high yield bond. So it makes a lot of sense as a product. Was it overcapitalized? I think if you look at things today, which is not the end of the game, it's just today, you might say yes. Were they chasing deals and perhaps priced them at lower yields than in hindsight looks like the right answer? There's probably a bit of that happened.
To that point, when it was, golden age, frenzy, what have you, there were stories coming out left and right of all these Cov Light deals, so much competition that things were overlooked.
Cov Light is more prevalent in the syndicated market than the private credit market.
Well, but my question to you is just, have things changed since then? Has there been any pullback in willingness to lend? Have standards become more strict? Are they more expensive now? Has there been a change just as there's been these
I think what we just saw that says, look, we're aiming for a smaller fund. That means demand's not there. It's all about supply and demand. At the end of the day, the more capital you have that are chasing these deals, the better terms the borrowers are going to get. When that reverses, it's the opposite.
First of all, you have to come on Danny's deal show.
You do have to come on.
Every Wednesday, she does an hour special on M&A, and you would be perfect.
Well, she is the brains of the operation, being a University of Virginia graduate.
Yes,
right.
Spoken from a true who. That is correct.
100%. That is, I won't debate that. I want to ask you about any AI concerns, because we had a scoop overnight that the chairman of the Fed and the Treasury Secretary called an emergency,
I saw that, yeah.
potentially secret,
Yeah.
meeting with the top
Which was
bankers.
immediately leaked to everybody because it's so secret.
Well, it was last Tuesday. That's not immediate in this news cycle. And they warned about the risks of AI. These are the very same risks that we've been worried about for the software companies that private credit is overwhelmingly invested in. Like some private credit funds have 30% software, whereas you have like
okay, and then you have some that have zero. If you look at a $2 trillion market, it is slightly larger in private credit than in the syndicated market. We're not talking orders of magnitude of multiples. So it is, there's slightly more concentration. Now, there's now a panic on software because of AI, okay? And clearly there are going to be some commoditized products that will be not renewed their subscriptions. You can do it in-house. But the mission critical aspects of the enterprise software, that's not going away. So the question is, and nobody knows the answer to this, how fast is the ice cube going to melt, and does it melt enough so that lenders are impaired? And the leverage on those companies is not, you know, at least at the time the loan was made, not overwhelming. So how, you know, okay, when something's trading in the equity markets at 50 times EBITDA, but I lend at 5 times, okay, I'm not concerned that the multiples in the equity market have contracted dramatically. I just want to make sure you're at 5 times plus.
But so I wonder if, to some degree, some of it becomes a self-fulfilling prophecy. And there was this reporting that this one of the Thoma Bravo software companies that Blackstone and its other lenders were basically going to call time on it, that they weren't going to extend anything. And is there some degree where even if the company is strong, there's just enough concerns around software that capital markets freeze up for these companies and just make life hard?
Some do, and then you have someone else who comes in and says, I can get 300 basis points more yield by making this loan. So if you have and this is the end of the day, this is what it comes down to. How does the economy perform? How do the companies perform? And I'm not seeing a rise in defaults among the software credits at the moment. I don't have a crystal ball. I don't think anybody does. It is something you have to watch because AI is going to be massively disruptive throughout the economy.
Right. Actually, I want to get your take on that.
Yep.
Unrelated to private credit.
Sure.
As a lawyer who's been in practice for a long time, is AI something that you and your colleagues use to replace the work that first and second year associates would normally have done? Like, how fast is that
I don't want to
growing?
get too in the weeds, but a lot of things first and second year associates do are not going to go away. Due diligence, closing docs. So, you know, but is there a category of work that lawyers do that's going to be replaced by AI? The answer to that is yes, and it's starting right now. We've just hired a team that's up and running fast. It is something that you have to get ahead of the curve of if you're going to succeed. And I think there are some people who it's just too big. They don't want to deal with it. Those firms that deal with it head on and hire the best people, we've got Stanford engineers working on this. It is going to be okay. Is there going to be a reduction in hours that lawyers are working? Yes. May the pricing model have to change? Perhaps. All of this is to come. But you have to be on the cutting edge of this, or you're going to have a problem.
I also want to ask about, you mentioned Drexel, Burnham, Lambert, and Barbarians at the Gate has to be one of the greatest books on the financial industry. You have written, I don't know, 4 or 5 books now, very successfully.
3,
as an author.
Okay, I'll take 5.
Okay. Is this private credit blow-up going to be worth it? Or is it such a flash in the pan that that nobody will even bother?
Well, nobody knows at the moment.
Right.
Okay. And there's always a name associated with a crisis. Anna Sorkin, and Brian Burroughs, Barbarian. You know, we don't know who.
Sorkin on Bloomberg TV? That's our competitor.
Well, Howard Marks put him in the left. Okay. So, who is going to be the private credit storyteller? We don't know that yet. And has anyone raised their hand? Right? How big a crisis is it if no one's saying, I mean, you people think about all day how you're going to attach your name to great historic stories.
Yes.
We haven't seen that yet. And you guys are pretty smart, so maybe it's not going to be this historic sort of blow up. I don't know. I don't have a crystal ball.